Hey Andrew, how you going? Nice to have you back.
Not too bad. We're back. The holidays came and went pretty quick.
And we're back in 2026. So this is actually my first podcast, 2026. So we've had a bit of a delay. So it's good to have a familiar face. There's a bunch of things that have happened though, like in the last, I'd say from October last year until now, lots of things have happened in sort of like the finance industry, lending industry, sort of. I think one of the biggest points that I've noticed was that the banks have fled from the trust lending. I don't know if you saw that. And I'm talking about major banks. So CBA, they've come out and said, we're only going to do trust lending for existing clients who've had a relationship with us for 6 months or more. Westpac have always sort of had this, like, you have to write it through commercial bank. You can't write it through the normal channels. Mm-hmm. So you have to have some sort of commercial lending with them in order to get access to sort of the trust structure. And to clarify, this is buying residential properties in a trust.
Yes.
Yes. And then, like, who else is there? Geez, it's like
there's Macquarie Bank as well.
Macquarie Bank. That was a big one. Macquarie Bank was a huge one because that was sort of the everyone would use Macquarie Bank, and they had a really good policy. In fact, when people would borrow in a trust, Macquarie Bank could sort of ignore, with an accountant's letter.
Yes.
And I think there's maybe some, there might be some creative accountant's letters, I'd say, that was sort of floating around a lot of these applications to say that the trust was operating profitably. Yes. And then it allowed Macquarie Bank to sort of ignore that. And I don't know exactly what changed it. Maybe their book got too risky or something like that. Too many trust loans in their book.
I think, yeah. To be honest, I think there was a lot of that happening. And if you saw, you'll see all these ads pop up on Facebook, and we spoke about this last time, where if you go out now, you set up a company, you set up a trust, and tomorrow you can go lend, which is it's not the case. The banks will always want to see some sort of history, see what's going on. But yes, there were some dodgy, I think anyway, accountants out there that were writing the letters, and basically people were getting funding with trusts that were not doing much, and the accountant letter would sort of get them over the line. So it just stopped.
Yeah, sorry, it stopped. You got kicked out and came back in for some reason.
That's weird.
Yeah, sorry. You said
So what were we saying? Yeah, so I think the banks realized this, and the government realized this as well, that there was a lot of lending that was happening, and especially with the property market at the moment, a lot of speculation that there is. I think they had to sort of tame it a bit. I think this was one of the key drivers or levers that they could pull to sort of slow down the housing market. Yeah. So on top of that, they also introduced the ratios as well, which you can probably touch more on about lending to investors.
Yeah. So they're putting a cap on. Usually, you'd look at it's the income. So debt to income ratios, and previously they could add on like rental income and stuff like that. Mm-hmm. But with investors, they're sort of capping, the DTIs with different banks. Look, it's when I say that though, a lot of these big news articles, like when it comes to the debt to income ratio changes, when it comes to trust lending changes, they do really tackle the major banks. And so you see a lot of news articles sort of saying, hey, there's trust lendings in chaos, or, investors, it's, struggle for investors. But the main thing is that those DTI rules came from APRA. And so it really only triggers for the deposit-taking institutions or the banks that are offering
big guys
as well. Yeah, that's right. So there's still a whole scheme of, lenders out there that can still do trust lending. They can still do the old accountant's letter trick, and you can still have that unlimited borrowing power. It's funny. I hate doing that. I said that sort of in irony, though. Like, I hate the whole unlimited borrowing power thing, because that's where it all came from. It came from this idea, and a lot of people were plugging this idea. I saw on social media an ad where this guy's saying, we're going to teach you in our course how to, get unlimited borrowing power through trust structures. And basically they were saying, just do this, then get an accountant's letter saying that the trust is operating profitably, and then do it again, and then cash out from the equity of that property, and then rinse and repeat, and just keep doing that as the property grows. Just keep pulling out equity and then buying another property.
And which only, sorry to interject, only works if prices continue to go up, right?
That's right. And it only works if the property is actually profitable. And I like, in theory it works. So if the trust was profitable, then yeah, 100%. Why do we need to look at that in servicing? I get it. I get the policy. You don't need to look at it in servicing, but how many of them, like you said, how many of them were actually profitable, especially year two? Highly leveraged investment property. They pulled out equity. So we're looking at borrowing 110%. They chuck it in a trust, and then they're telling the bank somehow from an accountant's letter, from a very friendly accountant, I'd say, that the whole trust is operating profitably now after 6 months, and then they're going to buy another investment property. And I think that's that type of practice or that type of advertising from brokers and property spruikers and stuff like that creates these issues where the banks have to say, hey, look, we're going to turn off. It was a good policy, but people taking advantage of it, right? So that was a big issue, and that sort of came up in the last few months. So we actually had a few loans that were heading to sort of trust structures that we had to quickly sort of move across to another lender. We sort of had it prepared for a certain lender, and then we sort of had to go, okay, well, we have to pull that out and move it across to a new lender because, the big four banks have just lost their appetite for it.
But it's a bit weird as well. Like on one hand, you have the government, the Labor government, trying to slow down house price growth or investment property growth, because obviously they're putting a directive through to the banks about risk and saying, look, you need to lend less to this market because they're really driving price growth. And I think they're trying to do that, as in the Labor government. But then on the other side, you've got the 5% deposit scheme for first home buyers.
Yeah.
So you've got that scheme. Yeah. And they push
with no price cap, by the way. So you've got these sort of wealthy first home buyers coming in, and they can get access to the scheme, where previously it was sort of like means tested. It was for the lowly first home buyer trying to get into the market. Now it's, hey, look, if you're a first home buyer, if you haven't purchased a property in 10 years, actually, it's not actually first home buyer. Like if you haven't owned a property for 10 years, then you can actually still get access to the scheme. So,
so yeah, you've got one side where they're trying to slow it down, and on the other side they're trying to speed it up. And I think that's what's really pushed the market over the last few months. You've got all these DTI changes. Yeah, you've got the trust lending changes. So you've got all of a sudden this rush of people, plus the 5% deposit scheme as well. You've got all these people rushing to the market already when we have not much stock. You have migration, which is coming in. You're letting a lot of people come into the market, or as in the Australian population. They've got to live somewhere. So they're definitely going into housing. So it's like you've got all these people pushing towards demand. You've got those 3 or 4 levers pushing demand, but you've got no supply. So of course, naturally, what's going to happen? Prices have to go up. There's just not enough stock out there.
Yeah, and all the government's schemes to increase building of properties and increase available properties and stuff like that.
It's not working.
No, it's not working. There was one, and you might know this, Andrew. There was one scheme that they set up, and they set up a few years ago, and they hadn't built a single property. I can't forget what it was. I can't forget the scheme, but the government set up this new scheme to build properties and create stock for for first home buyers and people moving into the country and stuff like this. And in like 4 years of the scheme, there hadn't been a single property been built. And you're thinking, okay, well, yeah, how are we possibly going to manage, especially the influx of immigrants and the already sort of housing crisis that we're already in, and we can't build a property. I've actually spoken to a few property developers recently, and they're saying it's so hard. Like they get taxed at every corner. Yes. And I think it's a knee-jerk reaction from the the rest of the population that goes, oh, there's a rich developer. Why should they, why should it be easy for them and stuff like that? But, developers do create, like we're saying, stock, where properties, they build properties for us, you know what I mean? And for Australia, and they ease that sort of property tension, property price tension. And they're getting taxed they get taxed by the state government, they get taxed by the local government, takes their cut, they get, I had someone who wanted to put down and knock down and build 3 townhouses in the Blacktown City Council, and they got quoted $120,000 council contribution.
Just fees, yeah.
You know what I mean? To collect your bins or whatever the council does, And so you're just thinking, and that's just local council. Now, you're going to have to, there's more fees and there's more tax and there's, all the way up to the top. And it just becomes so unprofitable. Most of the developers' profit is just given away to sort of different levels of government. And so it makes you think, well, why would I want to be a developer? Why do I want to put so much of my capital and money into developing if I'm just getting taxed at every corner? So yeah, there's this big conflict that's going to be really hard to overcome. And I don't know if they've got anything in the future that's going to curb this housing price issue that we have. So
yeah, look, I think all they need to do, and it's very simple, is just hold. Like, I'm not saying cut migration or do anything like that. Just pause. Okay, hey, let's just work out where we are, what we need to do, and I'm sure they can tap the shoulder of the private sector. We have good CEOs and all those private sector companies as well, all those developers. What can we do? This needs to be like, it is a national crisis, because the generation underneath, like, they cannot get into the property market. You cannot get into the property market in Sydney unless it's $1 million minimum. You need to have a dual income of over 150, 200 grand just to afford it. So now, where are those people going to live? What's going to happen? The cost of living is going up. You have interest rates, which we'll speak about. They look like they're going up next week as well, because there's just too much inflation going on.
The inflation's gone up too, hey?
So it's going to cost more money for these houses because everything is going up. So it's like, this is going to cause a longer term issue structurally as well, because now you're having a lot of people go into a lot of debts. It just takes a bit of uncertainty overseas in the US and Europe, and there's a bit of a GFC that happens. People start losing their jobs. All of a sudden, it's like you've got the whole housing market, and you're going to go light a match next to it, and you don't know what's going to happen next. And we saw this happen in 2008. It also happened around 2012. There was a slowdown. 2018. So I think people are not prepared for what happens on the other side if things go wrong as well.
Yeah. So I got to ask you though, based on that, would you say now's a good time to get to invest in property?
Man, I think I think next week, like, it's a push and pull. You've got you've got the demand factors that are there. There's not enough supply. You've got heaps of demand with migration, with people moving into bigger homes and the rest of it. So naturally, prices should go up, but the cost of interest is going to go up as well. So that will happen over the next few months. And we've been speaking about this all year last year, saying it's coming, and it looks like it's going to be here. And particularly because we've had a few specific items, which are electricity, groceries, and housing, which have contributed all to inflation, which I think everyone feels it. When the government says, last quarter only grew by 2%. We know it's not growing by 2%. Like, we can feel it when we go down to the shops, go buy something. Everything's expensive. So I think they need to tackle that first with the housing problem, because they're working hand in hand together.
Yeah, I also think, look, to be honest, I think when it comes to that, that question that I ask is about property investing. That it's property investing is not about. I always say it's not about like sort of when you buy, like a lot of, because they're long term, right? These are like 10, 20 years that you're meant to be investing, as opposed to sort of they're not like stocks that you sort of day trade, right? They're property, and so I always say that, the best time's now if you can afford it. But in saying that, it is really important that you do know the risks. Like you say, okay, if I do buy now, there might be an increase to interest. There may be an issue with different policy changes of the government. As long as you sort of know the context in which you're buying as an investor, I think that's fine. And you're happy to sort of ride those risks. As opposed to sort of just being like, oh, I'm too scared. No, there's too much going on. I'm not going to invest at all. You know what I mean? And then you never really do that. So
Well, I think a lot of people entered the market last year, especially towards the end of last year, on the hope that rates were going to get cut, because it looked like, I think in October, November, they did actually cut interest rates. So, the RBA sort of jumped the gun a bit, and then all of a sudden you've got this massive rush of people saying, well, if I can afford my mortgage today, in the next few months,
definitely
it's
be able
going
to
to get
afford
cheaper.
it. Yeah,
You know what I mean? So I think, there's that misconception where things can go up and down really quick. It's not the space of like, oh, it's going to take years. All of a sudden now, because the energy rebates got reduced, inflation has creeped back. Now what we're seeing is inflation is going up. So because of that, the RBA has to move. If you're tied into a massive mortgage, and this is where the risk cut comes into play, if you've got $1 million mortgage, yes, it's only going up 0.25% or maybe a bit more. It's only going to take a few $100s out of your weekly budget. But what happens if there's another one, or if there's 2 or 3 of them in a row? All of a sudden, your free cash flow goes to paying extra interest. So then what happens? You sort of get caught between a rock and a hard place. You have a beautiful house with a massive debt, and you'll never leave it because you haven't got money to spend outside because you're just spending it on interest.
You're just spending it on interest. Yeah. And that's people who can stay afloat that way too, because most people will then have to be pushed into options that they don't want to consider, like selling the property, going back, hitting the rental market, maybe releasing the cash flow in their equity and all that type of thing. Or but I'll tell you where I see inflation most at the moment is kebabs, man. I went to get a kebab the other day, and they wanted to charge me $20 for a kebab, and I'm just like, $20? Like, it was $18. But do you remember when kebabs were like $6.50? Like, I swear I used to be able to go to the shop and get a $6.50 kebab, and that wasn't that long ago. And I'm like, surely inflation hasn't been that strong. So anyway.
Yeah, well, the one that gets me is cappuccinos, or coffees. A large cappuccino costs like $6.50, and it's like, man, are you serious? It's dirty water. You know what I mean?
Like $2.
The large ones used to be around $4, and it's like, man, $6.50. It's only $2. So I get it, but it's like if you have multiple coffees a day, all of a sudden $2 extra on top of what you were paying. Yeah, that's where it creeps up.
Adds up, especially if you have a couple a day. That's for sure. Now we did talk about trust lending. I wanted to ask you as an accountant. So I know that there's the old maximum borrowing capacity and just sort of rinse and repeat that strategy. It's more of like a lending strategy. But for those who don't know, why do people buy property in a trust? Like, why is that? Is that a good investment strategy? Is it just a bit of like keeping up with the Joneses just because, old mate did it in a trust, I should do it in a trust as well? Or is there an actual proper tax strategy for people to buy in a trust other than that, like I said, other than that sort of maximum borrowing capacity type thing?
Sure. So look, it's more, it comes down to the family as well. So as you sort of get bigger or you get richer, what you can start doing is purchasing properties in trust. So then when those properties start earning an income, you can distribute it to other people or other family members within that trust. So this is where, especially if you have properties, and made sense before when they're positively geared. If you have a positively geared property and it's making $10,000 per year, if you're on the highest income tax bracket, you wouldn't want to send that $10,000 to that tax bracket or that individual because you'd be paying 47% tax. So then you could see, you could pass it on to someone else that's within the family trust. It could be a spouse, it could be a child, not a child, but an adult child. It could be someone else who's got a lower tax bracket, and that's essentially what those trusts are used for when it comes to the family.
Yeah, so you can't pass on anything to a child anymore.
If they're under 18, unfortunately, the government has cracked into this loophole a long time ago.
Yeah.
And it's only a few $100 a year, which you can
Yeah.
send
Okay.
to
So
children
still,
before you pay,
still can do like a couple $100 a year or something like that.
which is probably not worth it, to be honest. And then
Yeah. Yeah. Especially if you're making $10,000, plus, profit. So, okay. All right. No, also, because I find a lot of people don't actually understand why you're buying a trust. And they just do it because they hear that that's what everyone else does, and they hear big property investors do it. And I find a lot of people aren't at that stage where they need to even consider buying it in a trust, if that makes sense.
Exactly. And then like even with trusts as well, it's not really designed for negatively geared properties because you can't push down negative gearing losses to individuals. Whereas if you buy a property in your personal name, if there is a loss, a negative gearing loss, you can put that against your income. So this is where it's like it forms part of your overall tax strategy. And again, you're thinking about 5, 10, 15, 20-year plays, because if you buy a property that's negatively geared, you're going to lose all those deductions for a long time until that property starts turning positive, which happens probably around year 10 or year 15 in the normal scope of things. So then you can start using those losses, which is a long way down the track. But if you're you're a high income earner, it may make sense to buy in a trust now and hold those losses for later, because maybe you get to an age where you don't want to work anymore. You could be 50 years old. Then you can start taking those profits from that trust each year as it sort of after it eats all those losses. So this is where it starts to become a bit complex, but this is where tax planning comes into play. It's all about your life strategy, not just about year to year, because if you look year to year, it won't make sense, especially when you're buying negatively geared properties to start with.
I always say that when someone's first starting out buying their investment property, they should always speak to an accountant. And it might be a very quick, hey, I'm looking to buy an investment property. Sure, you know what I mean. No drama, like there's nothing to it. But especially if you've got a goal of buying lots of investment properties, is I see a few clients who've bought maybe 2 investment properties. They've got their own occupied property, bought a couple of investment properties in their personal name, and then they've gone to the accountant. The accountant's gone, oh, you probably should have done this structure.
Too late.
It's too late, right? So you should have. And then they're like, oh, and so they're trying to buy like the 3rd investment property in that structure, but it's sort of like, well, it's pointless at this point because a lot of the wealth is now in whatever structure you set it up initially in. So
exactly.
An accountants is so important. I also find a common issue that I see people have when they're trying to contact a professional. So you have Johnny. I'm just going to call him Johnny, or Bob, and Bob wants to build his wealth, right? And they want to build their wealth, and get the right professional help. So I find, generally speaking, a financial planner can assist, and they help with retirement, financial products, superannuation, where to invest those funds, how to structure that in a certain way that's going to be beneficial for them, with really a view for retirement, right? View for the future and how to build that wealth. And they help with insurances and stuff, especially, which is important, especially if you're starting to build that wealth. And then you've got the accountants who help with all the tax planning and, making sure that the structures are tax efficient. And then there's, opportunities for future, that they're not going to get themselves stuck because they're in a, bad structure. What I find is when people sort of say, okay, I want to build my wealth, and this is the key here, I want to build my wealth through property. There's no one, because the financial planners generally will say, okay, well, they specialize in financial products. Property is not a financial product, right? So, they can give some tips and help. But I've sent clients to financial planners for property investing, and they've been turned away. Not turned away in a bad way, but they've said that that's just not what we do. We do your self-managed super fund. We can help you maybe set up a structure to invest in your self-managed super fund. But when it comes to outside that, I mean, we can't give you advice of where to buy and what type of property or anything like that. And then accountants, again, they can help with the structure of how you invest from a tax perspective. And then you've got sort of the buyer's agents in the middle there. And buyer's agents, I mean, depends on who you speak to, but buyer's agents sort of have that sort of salesy feel, and that, you know, a lot of people that speak to buyer's agents just don't necessarily feel like they're helping them build wealth, just buy property. And so buyer's agents are really good at helping you buy property, but might not be necessarily good with the sort of long-term wealth planning side of things. So I wanted to ask you, you're an accountant, and you've also done a bit of buyer's agency stuff. So I wanted to ask you, so if someone came to you and said, I wanted to build wealth through property, who do they speak to? Who can they chat to?
Oh, look, I think so. This is a tough one. This all comes back down to your team. You know, like what happens, especially as people get like they have a larger wealth, they have more money. We look after a lot of clients that have a lot of money. What they want before they look at buying properties or shares or anything like that, they want to have a good team. So this is where you need to get your ducks in a row, because you need to have a good tax agent or accountant. You need to have a good mortgage broker, a good lawyer, a good BA. If you have all that working together in harmony, it makes the process a hell of a lot easier. Because the last thing you need is, you know, somebody goes and engages a buyer's agent. All of a sudden, that buyer's agent has said, let's buy this property, let's put it into your name. Then they go see an accountant after, and the contract's already all done. And that process, you know, and then they go get finance afterwards. They should have got finance before. So it's all about getting the right team, you know. And I always tell this to people: you always need to get a good team. And once you have a good team, then you can scale. Just like any business as well. You start off as a solo entrepreneur. Now you start, then you get good people, you get good processes, and you get a bigger team, and you can replicate. It's the same thing when you're building wealth, whether it's property or shares or whatever. Get the foundations right. Once you get that right, then all of a sudden, if one day you wake up and you're like, look, I want to buy a property, you already know the team that you need to call. Let me call this person first, and then start the process to get it done. You know, so. Like a property is one of those things as well, like the BAs as well, they cannot recommend, like they cannot give financial advice. So they can also just give you information on which properties have gone up and just say, hey, well, this is what the data has been trending over the last, you know, so many years. This is why, you know, you should be looking at this area. They can't actually say buy this property as well. You know, And this is where I go back to my point before. It all works when prices are going up, when everybody's making money, it all works. But it's when things turn the other way. It's when properties don't grow. You know, I've seen buyers agents come up on my feed. Everyone does. You know, they're like, well, we bought this property for a client, and in 18 months, it's gone up 36%. And it's like, cool. Like it may have, right? But again, we had COVID. We had massive amounts of stimulus that come from the COVID or the COVID boost. We had all that money from people that weren't working. That's all moved into the housing market, into the asset markets, whether it's shares and the rest of it. So now everyone's expecting that everything is going to continue to grow, you know, at the 36% or whatever it is, right? Which, if it continues that way, it causes the system to become very unstable. I'm talking about the banking system, because if prices go up that much, that quickly, there's going to be a GFC. This is what happened in 2008. Speculation, and you can see it already now. There is a lot of speculation that's happening in the market. Yes,
absolutely.
There's demand that's coming from migration and all these schemes, but at some point, you know, it has to stop, because wages have to keep up with what people are paying, and that's what's going to happen. You know, whether it's this week, whether it's tomorrow, whether it's in 5 years' time, at some point, those numbers are not going to make sense for clients.
Do you think there's going to be a sort of a great exodus from the buyer's agent profession in a couple of years? And there's going to be not so much money in the industry.
Oh, look, the good ones, like in any business, will do really well. Whether you're a mortgage broker, you're an accountant, you're a BA, it doesn't matter. If you're good at your job, people will always come back. You know, and people, you know, you're going to have those people that just want the quick gains. And yes, you know, if you bought a property in December, maybe it's gone up, you know, 2-3% already, possibly, right? But it's also, you got to think about the longer term. We're talking about a 20-year game, you know, 25-year game. If you just keep buying these properties on the hope that things are going to go up 30%, when things happen like next week, when they increase interest rates, and it sort of breaks that plan apart because no one was expecting those rates to go up, at some point that pressure is going to come from somewhere. Someone's going to pay for it. You know, and if those mortgages are on your shoulder, then obviously the bank's going to come chase you, and this is where, you know, the spiral happens.
I think people do think, like I think we live in a society where everyone wants those sort of short, quick gains as well, and 100%. So, you know, they see they see, I'll use Bob again. They see Bob's bought it. Well, the buyer's agent really, or like the real estate agent or whatever has said, hey, look, here's Bob, and Bob's, bought last year, and now it's, he's got so much equity. So, come with us and use us as a buyer's agency. And no hate to them, good advertising. They're just showing, they're just cherry picking a good client that's got a bit of growth, so be it. But what it does set is it sets this expectation for a lot of clients, and people are not fully versed in the property market and how it works. They just go, okay, he bought there in this suburb and he got heaps of growth in 6 months. Then I'll buy in that suburb as well, and I'm going to get the same growth. And I see it on a smaller scale. We're talking about like GFC and stuff like this, but you see it on a small scale where people, come late to the market or come late and they don't get that, and it actually puts them in a tough position because they're thinking, okay, I was doing this, I'll get a guarantor out to get this property. And the idea is that I'll release my guarantor within a year because, the property's going to go up so much. And that's what my buyer's agent said. And they gave me all this information about, the property value in the area and how it's going to increase. And it's not, year comes down the track, hasn't increased. And now they're in a tough position where they've got a big mortgage and they don't have the equity that they thought they'd have. And, the rent's sort of stagnant. It hasn't sort of improved like they thought it would improve. And then we've also got all the lifestyle things, jobs change. I was in a secondment. Now I'm not in a secondment anymore, and I'm not earning as much money as I was. And it puts people in a tough position, and that's at a smaller scale. So if that happens at an Australia-wide scale where there's lots of people having that issue, and like you mentioned, we're sort of down that track, especially with all these changes and government schemes and conflicting priorities, then it's going to be a big problem for a lot of people.
I think it's going to cause a big political problem as well, because on one side you've got the Labor government saying you want to help people get into the housing market, but you can't do that by pushing the prices up with your schemes. Like it's a catch-22. It's like either you want to help this side or that side. So I think the next thing that they're probably going to go after is going to be capital gains tax. If you keep property for longer than 12 months, you get a 50% discount on capital gains. So I think that's going to be one of Labor's levers that they're going to pull, because they're of the view, well, if you've kept this property, you've made so much money, we should be able to we should fully tax you, not get a discount. So I think that's definitely going to be in the woodworks, because there's a lot of money that's in that discount that investors are getting. And of course, the investors are seen as the baddies because they're making so much money compared to people trying to get into the market. So I think politically, that's what Labor's going to push to do.
Now they won't. I know I've spoken to you this before, and you think they might not change it, but I was just wondering if your thoughts had changed. Negative gearing, because that comes up at almost every election. They talk about negative gearing, and I've seen a few things recently, just on social media, where people are talking about the pangs of negative gearing on the economy, especially for first-time buyers and wealthy people looking to just get into the property market, build their wealth, to take advantage of the tax incentives. So do you think that will solve the problem?
To be honest, I don't think so, because you've got to think of it like this. When you do your tax return at the end of the year, if you're an investor, the biggest expense of usually any investment property is interest. And that interest goes to the banks. The banks then pay tax on that to the government. So it's like a big wheel where there's a lot of money generation, especially because the banks essentially are funding it. Whereas if they tackle capital gains tax, they're basically leaving the banks out of it. And the government will just say, hey, well, you have to pay us more tax because you made money on this property. So I think that's where it's going to be better. Well, I don't know if it's going to be better, but I think that's where Labor will sort of divert to, because if they hit negative gearing, it's going to impact the banks. So I don't think they want to do that. They want to keep the banking system stable and happy, because all of our super funds own shares in the banks, and the rest
I guess the contention to that though is that any of these strategies to reduce the stress on the property market and the housing crisis is going to have a flow-on effect with the banks anyway. So it's sort of like loans. The idea is that loans being taken out will reduce, like the median loan amount is going to reduce. which is going to impact the banks. It'll all sort of be sort of owner occupied, increasing owner occupied debt as opposed to investment debt. Will sort of not necessarily hurt the banks, but that's something that it sort of achieves that anyway. So I think, just to sort of argue the point, I still sort of think that there might be. I'm not either for or against. Like, I probably need to look into it a bit more, but that I feel like that's sort of like low hanging fruit. It's like, well, that's an easy one. It's an easy one for the government to just go negative gearing, and that might change some of the sentiment towards property investing.
Well, I think if they hit negative gearing, it's going to impact the front end of the market, like people that are looking to get into the market. Whereas if they impact capital gains tax, it's going to be people that have held it,
exiting.
They've held it for a long time. They've got a lot of wealth. They may flood the market and sell, which could be a positive for supply as well, because they're going to be dumping before the rules come in, possibly. But then again, property is one of those assets where you're gonna keep it for a long time anyway. So it doesn't really matter if you cancel the 50% discount. If you're going to be selling it in 2040, it's still a long time away. So this is where I think, if they touch negative gearing, it's going to impact the front end where people try to get into the market. Whereas if they impact capital gains tax, it's going to be at the end. So it's going to be interesting. They have to do something.
I hear what you're saying. It is interesting. It is really interesting to see how the different ways to sort of. It's definitely a problem the government's created. I completely agree with you. It's like there's all this talk about they're not tackling property prices. They're just tackling people getting into the market. So, like, for instance, the first home buyer schemes, all they're doing is just helping first home buyers get into the market where it's at, but they're not actually making the pricing more affordable. They're just sort of saying, well, okay, so prices are really expensive. Well, let's help the first home buyer get into the really expensive property that they're going to really stretch to afford, as opposed to sort of saying, hang on, there's a bigger issue here. Let's see if we can get the price of the property to a manageable level. And I've always said this, that I think I've always spoken about, like, property developing and stuff like that. And I think that it really is key. I think if the local government and the state government and stuff stop sort of taking a little bit off the top of these property developers and just like let them go ham in some of these sort of regional areas, or sort of and just like build up, just let them do it, and create incentives for that. Let the population sprawl out a little bit from the city center, and that's going to create so much more affordable housing. And we don't need the CBD, in theory, especially since COVID, where everyone discovered all of a sudden that you can work remotely. It's like, okay, well, let Australians work remotely. Like, if you can, mate, let them work remotely. Let them move out to Whoop Whoop, with a good internet connection, and do their job from there. And then that's going to ease the pressure of some of the sort of more metro areas and the pricing issues that they have. But again, that's even when we're talking about property developing, the immigration is coming in so fast.
We can't keep up.
Yeah, even if they did say that, hey, property developers, go ham, just start building. We're going to cut a lot of things that a lot of tax, and we're going to incentivize property investors, property developers. I don't know if necessarily that will still be quick enough to create as many properties. I think it'll always be playing catch up, right? It'll always be trying to meet those targets. So it might need to be a bit of a cocktail of solutions.
They've got to do something, like it's really expensive. It's too expensive. And if you own property, look, it's great. Prices continue to go up. You're making money every single day, but it's for those people who are trying to get into the market, which makes it really tough. Yeah.
Now, look, I'm just looking at the time. I thought of something fun that I was like, oh, maybe we can do this as sort of a fun podcast thing. I want to see, stuff using professionals. Like, we can do everything's on ChatGPT. We don't need an accountant. We don't need a mortgage broker. We don't need a buyer's agent. It's just on ChatGPT. So I thought I was going to check. I want to hear your thoughts on these are the top 5 suburbs to consider in 2026 according to ChatGPT. Okay. So we're a property investor looking to get in the market. The number one property, and I'll tell you why ChatGPT reckons it's number one. The number one area to consider buying an investment property in 2026 is Bankstown.
Mm-hmm.
Okay.
Yep.
Strong recent growth, good rental demand, capital gain potential, backed by consistent growth patterns and improving local amenities.
I like it.
What's your thoughts of Bankstown?
Man, they've got the new metro, so Bankstown is 20 minutes from the city, so that's why the whole area is peaking. You know,
that's true. I forgot about that. I saw Bankstown. I was like, okay, it's an interesting one. I haven't sort of heard that, but that makes sense.
So now, like, I think, so obviously the Northwest, the Rouse Hill area, Kellyville, that all boomed because the metro came.
Yep.
Now I think the metro opens there and it fully connects into Sydenham or past Bankstown. I can't remember the name of the suburb, but basically it connects, I think, in another few months. So you should be able to catch a train from Tallawong all the way basically down to Bankstown on the metro now.
So it will actually connect through the city, like the metro will actually connect through and carry all the way to Bankstown.
Exactly. And then eventually we'll connect to the airport, the new airport in Badgerys Creek, which then will connect back into Tallawong. So they're going to do a full loop, like a full 360.
Yeah. Okay. All right. No, interesting. Bankstown. Yeah, that's the. I'm just having a look on a map too.
Literally 20 minutes by metro, I think. Or I saw the state government spruiking it a few weeks ago. 20 minutes or 25 minutes.
Yeah. That whole sort of Western Sydney area sort of improved over the last 10 years. Like there's a whole bunch of planning, a whole bunch of developing happening there. I know it's a bit further out west, but like there's like the Western Sydney Airport as well, which I'm sure creates a bit of attention. But Bankstown, they've also got a Bankstown Airport. True. Okay. All right. Well, look, that's probably number one. Good play. Now, I also know a lot of people buying. I had a few people buying around Bankstown area, and they're buying apartments as well. And a lot of where those metros, even in sort of Kellyville and stuff like that, they've DAs to put up these big, apartment buildings, and that's going to be sort of the new normal around metro, I'd say. So a lot of the suburbs are going to be turning into apartment buildings, which again creates more properties. So I know some of the locals don't feel so keen about it, and it takes away their skyline a bit. But
look, I'm not an apartment expert. I don't like apartments. I had one, and the issues they have with strata, the strata committee, with the insurances, with the capital works, the sinking fund. It's just not my cup of tea. And you may have a bit of capital growth, but in saying that, especially with apartments, they could put another one next door. And there's thousands of them. So it's like, what's different from your apartment to the guy next door? So
I know you're not an apartment expert, but why would you buy an apartment? Because I have the same sentiment. I have the same sentiment as you. I'm like, look, apartments. There was a time where I felt like everyone was getting to the market on an apartment, but I've seen. I won't say it because they're clients of mine, but I have seen a few clients who've been spending exorbitant whatever amounts of on special levies and strata fees.
Oh, it's insane.
And
I've seen
I
it
think
too.
there was one where they had to reclad. There was sort of reclad the building because there was sort of
the fire stuff.
Yeah, exactly. And so they created a special levy, and it was just so much. I'd never seen that amount before. I won't say how much, but it was north of 10,000. That's so. Of course. It was just so much. Anyway, all right. Lidcombe is number 2, mid-ring suburb, showing solid long-term growth, rental yield prospects, popular with families, and close to transport links.
Yep. No, so Sam, I think Bankstown, Lidcombe, like the whole area is just going up in value because of that, because the metro is coming. Lidcombe's already got a train station, but of course it's going to also have the metro as well close by. 20, 25 minutes from the city is pretty good. Jump on a metro.
Lidcombe is very quick to the city too. Very quick to the city. The other one, Mount Pritchard.
So, that's a bit further away.
Yeah, hold up. Sorry for anyone who's from Mount Pritchard. So I need to familiarize myself with my own backyard. Oh, it's like right there. It's all. I feel like these. So it's Cabramatta, Bonnyrigg, Liverpool, that sort of area. So it's all pretty much the same. Then there's Parramatta, Sydney's second CBD. Although I feel like Parramatta, people have been saying that's always on everyone's list for the last forever. There's a lot of apartments in Parramatta as well.
Heaps of apartments.
And they
heaps.
didn't. I know someone who purchased in Parramatta, and the apartment actually went down in value. So, you know.
Yeah, I know a few people as well that bought in Para. Same situation. That they promised all this capital growth and all this, and after you take out the levies, the strata, like it's probably going to be rented the whole time, but you're losing more than what you're getting in.
Yeah.
For me, I'm not an apartment person. I just it's not for me. It's good for some people because they want to get the depreciation, which is better for their tax. Which I see that point of view as well. And if you're buying somewhere where you want to live, eventually maybe, but to me it's like I'd probably just prefer to rent it, so I don't have to pay that big debt to purchase it, don't have to worry about strata, don't worry about anything like that, leave it to the landlord, and you just enjoy yourself. Whenever you're done, you move out of it.
No, 100%. I've never, and there's probably going to be people in Parramatta who are like, "Keith, you're crazy," but
you're crazy.
I've never known someone who's invested in Parramatta and got like a really good deal. Maybe if there's some planning changes or something, they got out. But anyway, the last but not least, is Campsie, which again, to be honest, it's all sort of down that. It's the same area. That must, like you were saying, that same area. They reckon, major transport upgrades, Sydenham, Bankstown Metro, good unit market, strong demographic demand. Campsie, interesting. So that's
Campsie is pretty close to the airport as well, like the
Sydney Airport.
It's a Sydney Airport, so
yeah. Okay, so and that's like that's right next to Marrickville and stuff. So really, from Campsie out to like Cabramatta, that type of thing. That's just going to be sort of a hot spot. But what's the median property price in those areas?
Now I think they're probably pushing like 1.2, 1.4.
Yeah, that's what I mean.
They also have really big blocks because they're old. They're all 500-600 meter square blocks, and they're going to be expensive.
I guess that what that tells you is that, like, if you can afford it, that areas in 2026 might be a decent place to buy. But what I find interesting about ChatGPT is that you really have to prompt it with all the details, like what's your budget, like what are you trying to get in, like all that type of thing. But you reckon it did all right, ChatGPT?
GPT, it's getting smarter and smarter, but you always still want to have a team. Like you can get all this data and say, hey, well, I'm going to go buy here. You still have to go through the process to get the loan, get the lawyer, get the accountant. It's still a process. Like this is a good starting point, and you could probably test your BA. It could be a good point of contact. But at the end of the day, this is a people business. Like you need to have the right team behind you to then get it done, because once you get really big and you have a lot of things going on, you just want to be able to call your advisor, whatever type of advisor that is,
100%.
and just say, make it happen, and I'll just do it really quick, and that's what we want.
And like we were saying before, there's no one that sort of specializes just solely on property wealth building. People will say that, buyers agents will say that, but really, if you're talking about long-term retirement, you want a financial planner. If you want to talk about tax strategy, you want to talk to an accountant. If you want to talk about borrowing capacity and lending, you want to talk to a broker. Then if you want to talk about where to buy, you talk to a buyer's agent. And so, you really need that team, and it's not one or the other. It's actually a combination of them. Yeah, everyone. So, and that's the reality of it. I think people like to sort of keep it nice and cheap, and hopefully their accountant can do everything for them. No, sweet. Well, look, thanks for jumping on. We chatted about a few different things today, so I really appreciate it. And hopefully there's some information out there that can help some people watching. So
perfect. Thank you. Thanks for your time,
mate.
and I'll catch you for the next one.
See ya.